Chaliye boss, everyone in the class, very good morning. Can you all see me, hear me? What is the status? People, am I all audible to you, visible to you? What do you all say? We had a delay today to start the session because today is AFM exams. So a lot of students were asking doubts. In fact, some people end up calling me even in the morning because this is the situation. So who all do we have in the live class today? Come on. Join in quick, people. Who all do we have in the live class today? 1 second. Shruti, very good morning. Other live people in the class, very good morning. So there are people who end up getting confused and at the end moment in a particular concept which turns out to be ultimately very easy or turns out to be something really easy. So this is what I was into right from the morning. Just 1 second. Because a student expect that if there is a student expect that if at an exam day, a teacher is going to pick your call, even if it is so early in the morning. Yes. So how are you? How is everything? People, all good, all set? Shall we get started? So in the last lecture, we started our discussion with what? Sir, we started our discussion with the dividend based valuation model. You learned at the end of the class that, sir, how is this formula? The Gordon's formula of valuing the share based on the dividends, which is ultimately d1 divided by k minus g. How is this particular formula derived? We made the help of maths using the concept of geometric progression. We did derive this particular formula, right? So overall, if I have to revise certain things, right, let me take it right from the start, right? Sir, in the class yesterday, we read first of all the concept of time value of money. So you had learnt in the previous class, Shivansh, very good morning. Yes. So you all had learnt in the previous class that, sir, if there is a 200 rupee of value today at 0 point, what will be its value at the end of 4th year? And similarly, what will be its value at the end of 4th period? When I say 2 year, it is actually 4 period. So it's like I have to name it as 1, 2, sorry, wait. It's like 1, 2, 3 and 4. So there are 4 period of 6 months each. So what will be the future value at the end of 4th period? Similarly, the present value at the end of 4th year, if there is an amount, what is the present value today? At the end of 4th period, there is an amount, what is the present value today? Then, sir, doubt abhi baat hui thi aapse. Yes. Shivansh, so you are one of the students who ended up calling. Yes. Were you watching my YouTube or something, is it? All the very best for your exam. All the very best for your exam. Sir, now if we talk about annuity, people, we learnt in the class yesterday that if we are multiple cash flows, if there is a same amount of cash flow after same time interval, we call it annuity. And for that annuity, we can calculate future value as well as present value. The present value calculation we had done in the class yesterday, with writing down the steps. But the future value calculation we did not learn. We were waiting for us to come to that particular question. That is when we will learn. Sir, then there are two possibilities of annuity, regular annuity and annuity due. If you observe, no situation is there where you will use annuity due in the exam, right? So let's put it off, but the point of difference was where regular annuity, for example, this is first year, this is second year, where regular annuity is towards the end of every period, which means cash flow is first year and second year and third year and fourth year end. In case of annuity due, the cash flows are towards the start of every period, which means first year's cash flow will be here, second year's will be here, third year's will be here, and fourth year's will be here. That is how the cash flows are. Perfect. Then we talked about perpetuity, of which future value calculation not possible, but the present value calculation is there. At this point, I would want to ask a doubt to you all. Are you all ready? If I ask you a question, a quick quiz kind of a situation, will you be able to answer it? Come on. What do you all say, people? Are you all ready for the quiz or not really? Come on, come on, come on, quick. What do you all say? Ready for the quiz? So make your calculator ready. Let me ask you the quiz. It's really simple. Sir, if I have 3 years of time period, listen to me. Harshita plus Shruti plus Archana plus everyone else who's sitting live, please listen to me. Suppose 3 years is my total time period. The amount of cash flow at the end of every 6 months is rupee 100. Fine. Cash flow every 6 months. Every 6 months. The cash flow is rupee 100. My rate of interest is 15% per annum. 15% per annum is the rate of interest. Can you all please give me the present value of this particular cash flow series that you have seen here, that you are seeing here? Come on. Present value of cash flows, where I will receive 100 rupee at the end of every 6 months for the next 3 years, where the rate of discounting is 15% per annum. Come on. Take your time, process it, then I will explain to you. Please, 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 waiting. Let me present it for you in a better way. Yes. Come on, come on, come on, recorded people, have the answer ready. Sir, did you realize how is this particular situation different from the previous one? Sir, in the previous question, my time period was annual. So as I said, the most simple way to understand it is really easy. Sir, my calculator, as I explained it in the last lecture, my calculator does not understand years, my calculator understands period. Sir, for calci, R will be what? For calci, R is rate per period. Sir, how much is the rate per period? Please tell me. How much is the rate per period? Sir, it is 15 divided by 2, which is 7.5%. For calci, N is number of periods. Can you tell me how many periods will be there in a total time period of 3 months, 3 years? So, sir, it will be 3 multiplied by. Every year I have 2 periods, 2 compounding periods. So, in a total time of 3 years, I will have 6 periods. So with that mindset, everyone, if you calculate 100 into present value annuity factor, where please observe the rate will be 7.5% and time will be 6 periods. Rate will be 7.5% and time will be 6 period. That is how you will have to do it. Yes. Are you understanding? And accordingly, if you total it, if you do the calculation, how will it look, people? Sir, it is 1.075. How do I do it? Please understand, it'll be 1.075. Divide. You have to divide it, discount it for 6 periods. So divide equal. 6 times, and then when you press GT, it becomes 4.694 on a rounded off basis. 100 multiplied by 4.694, which is equal to whatever you get at the answer is the answer. The point is to be able to learn to calculate the present value annuity factor if you have semi-annual periods. Requesting everyone in the class your responses. Are you please able to connect to what is going on? Super fast. How much out of 10 are you people please set? Why has not everyone joined? One second. Come on. Are you people sorted with this? The point of learning is that your calculator understands period, and that is what you will have to do. Set, are we all? Fine. Sir, next in the class we learnt about the dividend valuation model, where we learned that the present value of future cash flow is the value of a share. Agreed, basic. Sir, what are the future cash flows? The future dividends that I will receive when me as an investor invest in a share. What do I receive in future? The future cash flows. So for those future cash flows, the present value discounted at the rate of KE is the value of share. Two possibilities. For a finite, definite time period, if I have the cash flow, so whatever amount of dividends I will receive for my holding period and the selling price of the share at the end of the holding period, I'll discount all of them. Similarly, if I have my indefinite holding period till infinity, then present value of all the dividends right from point 0 till infinity will be discounted. Sir, there is no selling price. Did you observe that there is no selling price? Sir, in this case, I am holding the share for an infinite period of time. I will not sell the share. I will continue to receive the dividends forever. So I have to discount the dividends received forever till infinity. So discounting from D1 to D infinity at point 0 is everyone. Using the rate of K is the value of share. Yes. Come on, respond to me. Are you all able to recollect these two particular things which we learned in the last class? Super fast, yes or no? Quick, yes or no? Then, cost of equity calculation we learned, that's a discounting rate which is being used, can be calculated using one of the three ways. Way number one, using CAPM, RF plus beta into RM minus RF, where RM minus RF is called as market risk premium. So, without, sir, if this data is not available, RMRF data is not available, then you go to this situation where D1 divided by P0 plus G is the cost calculation of cost of equity. If that is also not there, then the earnings yield is the calculation of cost of equity, which is EPS divided by MPS. Did you observe the logic behind this particular formula is also again really basic and simple. What is the logic? Logic is that in the denominator comes the amount that you invest, and in the numerator comes the return on that investment that you make. Correct? So as an equity shareholder, sir, if their MPS is this, and by investing this MPS, if they are capable of earning this much as the return in the form of EPS, then they are making a total return on the amount invested at this percentage, this particular percentage. So that is the return they are making, which automatically becomes a cost to the company, which is why in the absence of this particular information, this is what is used as cost of equity for the company. Could you understand not just the formula but also the logic of why is it being used as KE? Yes, all the live people sitting here. So once you calculate KE with whatever method, you know it is being used as a discounting rate. So if you have to find out the price at 0 point or the value at 0 point, it is D1 divided by KE. Although all the dividends are same, right from D0 to D infinity, everything is same. So it become annuity divided by the discounting rate R, which is KE. But the point is, first dividend that the formula discounts is D1. D0 is not at all discounted. That is the first thing. Second, in case of Gordon's model, it is D1 divided by K minus G. The formula was really easy, but there were certain pointers more importantly to understand. Let me discuss the pointers one by one. A quick feedback I want to take. The revision that we do in the class, what do you feel? Like, do you feel it as a waste of time, or it is rather better that you are able to recollect the things that you have done in the last lecture? People, come on. How do you feel revisions? What do you say? Come on, come on, come on. Better. Yes. Shall we continue? So, sir, what were the important pointers that we thought, that we discussed that day? First, if D1, see, what is the first cash flow being discounted is D1. Is it D0? No. However, in the absence of D1, you can calculate it as D0 into 1 plus G. That is the first learning. Learning number 2, dividend is there. The dividend has to grow at a constant rate for us to be able to apply this model. Yes, till infinity the same amount of growth has to be there in the DPS, not in the EPS. And growth from which point to which point? Right from year 1 to year infinity. The dividends from year 1 to year infinity, the growth has to be constant. From 0 year to first year, growth may be anything, does not matter, because my first cash flow being discounted is D1. Then we learned that one particular thing I would want to teach you now. Listen to me. Sir, if examiner says the company paid a dividend, just declared a dividend, it gives me that the given information is D0. Then they say company is expected to pay the dividend, planning to pay the dividend, will pay the dividend, it gives to me a feeling of D1. But sometimes examiner says company pays the dividend. Pays the dividend is a generic word. It does not belong to the past, does not belong to the future. Sir, in that case, if the examiner's language is silent, unclear about the timing of dividend, then assume the dividend to be D1. Sir, is it a rule that institute has made? No. When I observed all those unclear questions, I realized that in 90% of the situations, institute follow or institute assume the dividend to be D1. In some rare case, they take it as D0. People, are you getting it? So D1 and not D0 is what you have to take, right? What you use in the formula, that is fine. But in case of confusion, assume the given dividend to be D1. Next, sir, you have to realize growth is from D1 to D infinity. We have also talked that the price to arrive is at 0 point. Sir, then the important thing that the very last thing that we discussed towards the end of the lecture was growth in EPS versus growth in DPS. I gave you an example. Let's assume that this is the 0 point where you stand, where your EPS was 100, payout ratio was 50, which is why DPS was 50 rupee 50. Suppose the EPS grow by 10%, it become rupee 110, right? Due to payout ratio being same, the growth, the DPS turns out to be rupee 55, the growth of which is again 10%, it is visible from 50 to 55 is 10% growth. Now we're gonna understand it further. Before I proceed ahead, are you people 100% clear about the things that we had learned yesterday or day before yesterday? Please tell me by putting up a like to this video if you have not yet liked it. Come on. Are we all excited to learn the new things for the day? What do you all say? Yes, people? All set. Shall we proceed? So now let me tell you that if my earnings again continue to grow at the rate of 10%. So let's say earnings again continue to grow by 10%. In that case, what happens? Sir, 110 plus 10% is 121 will be my EPS for second year end. Rupee 121. But suppose the payout ratio turns out to be 60%. Payout ratio turns out to be 60%. So accordingly, how much will be the amount of dividend? 121 into 60% is rupee 72.6. Is rupee 72.6. Can you people calculate the growth in dividend? How much do you think is your dividend growing? Please do calculate the growth in dividend. Waiting for the answers. Come on. Do calculate the growth in dividend. Quick, everyone. One second now. Today you will have to manage a bit because students do ask the doubt at the end moment. 32% is what you're saying is the growth. So 72.6 minus 55 divided by 55 gives me 32% of growth. You know what is the point of observation? So it was, everyone in the class, 10%. But this one, if you observe, is 32%. So why is it happening that the growth in EPS is not turning out to be the growth in DPS? It is people in the class because my payout ratio has changed from 50 to 60%. So overall, what do we conclude? Let us try to learn. What we conclude is that if the examiner is silent about the payout ratio, we assume the payout ratio to be maintained throughout future years, and with that assumption, the earnings growth and the dividend growth of all future years turn out to be same. However, in certain situations that I talk about now, meaning to say, let's talk about a situation where growth, you have to observe that growth is between two particular points. So right from 0 year to 1 year, these are the 2 points between which the growth is calculated. For those 2 points, if the payout ratio is same, growth in earnings will be the growth of dividends. However, between the growth is, as I said, between 2 points. For those 2 points, if the payout ratios are different, then growth in earnings will not turn out to be the growth of dividend. It will be different is the conclusion that I want to explain. Everyone, could I convey to you such a basic thing that when is the growth of dividend will not be the same as growth of earnings? Yes or no? Quick. And let me tell you the relevance of this, sir. What matters to me in the formula is the growth of DPS, dividends. What examiner may give to me is the growth of earnings. You have to apply your logics and brains to figure out, is the payout ratio constant? If yes, you assume the same growth to be the growth of dividend. However, if the payout ratio is changing, then you have to particularly remember not to use the same growth rate. Are you able to connect to what I explained, people in the class? Now, sir, there is a point of observation. But that observation is being written here as we go to the pages ahead. You will see that the observation is written here. This is where it is written. But you don't have to understand it now. This is particular page number 25 where I have written an observation. We will read and learn that observation when we go to that particular page, but it relates to the concept of payout ratio change that we will discuss later. Perfect. Sir, for now, what we have learned in the Gordon's formula, we should have D1 ready. Yes. Sir, we should have the cost of equity with us. Yes, we should have the growth with us. First possibility, examiner can give me the amount of growth directly, like it will grow by 10%. Second possibility, it may ask us to have to calculate the growth using the formula. Sir, what is the formula? The formula of growth is retention rate multiplied by ROE. The formula of growth is retention ratio multiplied by ROE. Please, people in the class, tell me how many of you have seen this particular formula at CA inter level? How many of you have seen? In CA inter also used to apply this formula of calculating growth as retention ratio into ROE. Please tell me, are you all able to recollect it or not? Come on. Are you all able to recollect? But the depth I am going to convey to you in this video right now in this lecture about this formula, that sir, if you calculate the growth using this formula, let me particularly tell you, this is the formula of growth, not of dividends but of earnings. Boss, this is the formula of growth of earnings. Yes, at this rate my earnings will grow. At this rate my earnings will grow. If the payout ratio is maintained, assuming, then dividends will also grow at the same rate. But if the payout ratio is changing, please remember dividends will not grow at the same rate. It is the growth rate, formula of growth rate of earnings, first thing. Second, do you people know the underlying derivation of it or the underlying common sense? Do you people know the underlying logic? Let me explain that logic to you. Sir, for the sake of saving time, see, for the sake of saving time, I will just copy it. I will just copy the thing from the previous batch where I explained, and I will focus more on explaining it. Wait. Cool. So understand such a simple common sense. Sir, you stand at 0 point. Imagine the financial statements of the company that said today the equity shareholder fund of your company is 1000. Let's assume there is just one particular share. So let's assume that the book value per share is 1000. Yes, at 0 point you stand. At the beginning of first year you stand where a amount of equity invested as per balance sheet is 1000. Since your ROE is 10%, what does it mean? That on the amount of equity which is invested in the business as per balance sheet, you will earn 10% as the numerator. What is the numerator? Numerator is PAT or numerator is EPS. Perfect. Can you please recollect the formula of ROE? Yes, sir. It is EPS divided by book value per share. Can I bring book value per share to find into ROE as my EPS? Answer is yes. If book value per share is 1000, ROE of 10% give me EPS of 100. Let's assume that my company's dividend payout ratio is 40%, which is 40 rupee. So rest of 100 rupee, rest of 60 rupee gets retained with the company. Perfect, logical, set, sir, fine. Now observe what happens to the financial statement. This 60 rupee which you have retained will ultimately gets added to this 1000 rupee of opening equity balance, equity shareholder fund, and my closing equity shareholder fund for that year become 1060, which becomes the opening equity shareholder fund of next year. So start of the next year, year 2, if I talk about beginning, the book value per share become 1060, where 1000 is the original amount of investment and 60 is the retained earning of first year. Agreed, sir? On this book value per share, if I again earn 10% of ROE, my EPS of next year turns out to be what? My EPS, people in the class, Krishna, very good morning. My EPS of next year, people in the class, turns out to be 106. Agreed, 1060 into 10%, 106. Can you please observe how much is the growth in EPS at the end of year 1 to at the end of year 2? Has my EPS grown up by 6%? The answer is yes. Now let's try to do one thing. Let's try to apply this formula. So the formula is really simple. If my retention ratio, please look at this. If my retention ratio is 40%, and sorry, if my retention ratio is 60% and ROE on that is 10%, so growth automatically turns out to be 6%. So people could you all understand that my formula gives me a growth of 6 and the calculation or the common sense gives me a growth of 6 in my EPS. Are you people 10 on 10 aligned to this? Everyone, please tell me. Are you all 10 on 10 aligned to me on this? Please tell me. Please, don't focus on writing it down. First, tell me if you are comfortable or not. So effectively, if you observe, why is there a growth? Because 100 rupee of EPS has become 106. Like what's that element, what is that component which is responsible for growth? Sir, this is this extra 6 rupee that you have earned has given to be the growth. Why have you earned this extra 6? Apply common sense. Sir, this 60 which I retained become the investment for the next year, and on that extra investment, when you earn 10% extra, you get rupees 6 as your extra earning. So which is what we are doing, what you retain multiplied by what you earn on that, which is retention ratio multiplied by the rate of return of equity, automatically gives you 6%. I have given to you the mathematical justification, the common sense behind the logic that what you retain when gets reinvested, you earn a return on equity on it. So that is what is giving you the excess return, excess profit. That excess of 6 is nothing but the growth that we are talking about. People, I need a response. How much out of 10 could I make everything super clear to you? Come on, please. What do you all say? Waiting for your responses. Are you all able to comfortably understand everything? What do you say? Is it 10 on 10, everyone? If yes, you may spend a few minutes writing it down, but really quickly. It's a derivation kind of thing. Try to write it down using pencil so that you have to know on the exam day that you have to ignore it. This is just for your satisfaction or your thoughts evolution that you are learning this. Come on, super fast, write it down. Whenever you are done writing it down, please let me know in the chat box. Waiting. Waiting, people. Whenever you have written it down, please let me know. Done. Harshita. Shruti, done. Archana, do you want to ask anything? Waiting. Yes, Archana. It's okay. You may leave. It's fine. Hope everything is all right. Take care. It'll be available on YouTube. Perfect. So, sir, we got the point now. So, we got the point that earnings growth is calculated like this. And if the payout ratio everyone is constant every year, then the same is dividend growth. We are all sorted till this point. Now we are all set to go to the practical questions. And now for the first time in our class, you will solve a practical question which is of CA final. Perfect. So this was about the concepts that we have discussed. Let me take you all to the practical questions for which, hold on for a second. Give me a minute. Just give me a minute. Let me open that practical question book. Just give me a minute. Fine. Perfect. So this is the out scanner. You must have received this version or some other version. But the point is that in the out scanner that you will receive, let me explain to you what happens. Suppose you are purchasing this class in, suppose you are purchasing in class in Feb of 2026. Right. For example, you are purchasing in class on 1st of January. If I stand on 1st of Jan, what is the latest institute's material available to me? Sir, the latest material available to me is the September 25 exam paper and RTP and MTP of Jan 26 attempt. So in that case, this book that you will get will be fully updated till this batch starts on, for example, 1st of Jan. So this material is fully updated till Jan 26 RTP, MTP, or you can assume simply it is fully updated till September 25 exam paper. Agreed? Now suppose someone buys this batch in the month of, say, November 26. When he is buying the batch, September 26 attempt has also passed, which means Jan 26 attempt has happened, May 26 attempt has happened, and September 26 attempt has happened. For these three attempts, whatever will be the new questions in the RTPs, in the MTPs, in the exam paper, all of them, people in the class will be compiled and to be added in the initial pages of this book. They will be added in the initial pages of this book as new questions in the last 5 attempts, something like this. Sir, what is the logic? Logic is really simple. For example, when I start this batch on 1st Jan 26, this book has 1 to say 45 questions in first chapter. After 4 months, some new questions come up. I can't insert them over here. Why? Because otherwise the sequence of question in the book and what you see on the screen in this video will be different. Perfect. Which is why, to match the sequence, even if you purchase the book later on, this original sequence that you see in this video right now will not be disturbed. All the new questions will be added separately before the start of any chapter. I mean, before the start of the chapter in the initial pages of this book. Could I explain to you what I mean to say, people in the class? so that you have a comfort of knowing how will the new questions be updated. Now, for those who have purchased the book right now, but is attempting after a year, how will he get a new question? He will get a separate PDF on the Telegram channel on his Google Drive. The name of the PDF is New Question by ICI, which has compilation of all new questions. People, please tell me, are you all set? Are you all clear with what I said? So right now you are seeing the September 25 exam paper here, but in your book that you will receive, okay, those who have already received the outscanner, you might receive the updated outscanner. Please listen to me what I mean to say. Sir, the updated outscanner you will receive one more, mostly you're gonna receive one more book without any additional cost. Okay, what that will have, that book have with all the questions till September 25 attempt already inserted at their place. For example, this particular question one, which belongs to equity business valuation topic, it has a particular placement that, for example, it should be become question number 43 of the book. It will become 43, and then you will receive that updated outscanner is what I'm trying to tell you. Perfect. For now, let's get started with what is the main point. Let's come to this particular page number 1 of your equity business valuation chapter, right? Please come to page number 1, where this is the question number 1 we will have to look at. Come on, super fast, please come to this particular question. Question 1, page 1 of equity business valuation, an extremely easy question. In fact, the level of question is such that without me trying to teach you, you'll be able to do it at your own because you have done it something like this at CA inter level. So shall we all proceed to do question number 1? Cool, fine. Sir, when I do a green mark on any question, it means it is being discussed in the class. Perfect. What it says, Amal Limited has been maintaining a growth rate of 12% in dividends. Fine. The company has paid a dividend of rupee 3, which means it is D0. Fine. So my D0 was 3 and dividends are been growing at the rate of 12%. Rate of return on the market portfolio is 15%, RM is 15, risk-free rate has been 10%, RF is 10, beta is 1.2. You have to calculate the expected rate of return as per CAPM. Beta RF plus beta into RM minus RF, and you have to calculate the equilibrium price. Sir, what do you mean by equilibrium price? Sir, it means the fair price, the intrinsic value is what you have to calculate. These are the two things you have to calculate. How many of you people feel that if I don't teach you this particular question, you'll be able to do it at your own? Please tell me. In fact, start doing it. Observe the data, find out what is needed, and then solve it. Then we discuss it after you are done with it. Super fast. And give me a minute, let me have water, please. Give me a minute, let me have water. Come on, answers please. Sir, what has been the RM? 15%. What has been the RF? 10%. What has been the beta? 1.2. Did you people try calculating the cost of equity first of all? Yes, sir. What is cost of equity? Shall we start to write this question and do it? What do you all say? Yes. So let's very quickly solve it on the calculator first, or okay, fine. Let's start to do it in the notebook. Just give me a second. Okay, wait, hold on. Perfect. Fine. So let's do question number 1, page number 1 of the outscanner. Yes, what it says, let me open the outscanner simultaneously, although it is there in front of your notebook. Sir, in the question, first of all, we need to calculate cost of equity. So we will say cost of equity. Sir, do we have to write down the formulas? Yes, always. Correct. So the formula is RF plus beta into RM minus RF. You first write down the formula. Then you write down the values. Sir, what was my RF? Sir, RF is 10. What is the beta? 1.2. What is RM? Sir, 15 minus 10 give you what percentage as cost of equity? So 5 multiplied by 1.2 plus 10 is equal to 16% as my cost of equity. Now the next you have to calculate is the equilibrium price. Equilibrium price which is again extremely easy. The equilibrium price is D1 divided by K minus G. Sir, what is D1? It's actually not given, so we have to take D0, which is 3, into 1 plus 12%, which is 1.12, divided by 0.16 of K minus 0.12 of G. In fact, let me write it the growth as 1 plus 0.12. So that everything in the formula which relates to percentage is in decimal and you are able to understand it better. Perfect. What is the answer? Please use your calci and give me the answer. Waiting now for your responses at least. Come on, what do you say? Come on, come on, come on. What is the answer? Is it 3 plus 12% divided by 0.04? Are you people getting 84 rupee, 84 as the equilibrium price? What do you say? Yes, such an easy question to do. So to the examiner, when you give this answer of 84, you will get your marks, right? To the examiner. When you give your answer of 61, you will get your marks. 16%. So step marking this and this will be the answer to this particular question. Such an easy thing. Actually, this question did not deserve to be done in the notebook. We could have done it on the calci. So let me explain to you how will the question solving work in this batch. The questions which are extremely easy, which is somewhere the repetition of your older question, those questions will be homework. Then the questions which are relatively like less easy, average kind of, those questions we do it on the calci in the class right now, which means they are the questions which you will have to do at home by writing them down on the notebook. Then comes the top category, which are ambiguous or difficult or comprehensive question. So we will try to make sure that one question of every type at least, although all the questions are that way unique, all the questions are unique, but one question of every concept, right, we try to do in the notebook by writing them down in the class, so that you have a comfort on the presentation also. Once you have the comfort on the presentation, similar nature easy question will be done in the class on calculator so that you do it, but how to write it is something you can do at home. And then the easiest question you will have to do as homework, either by writing them down or only on the calci. That I will guide you as we go to the respective questions. Question first was ideally only on calci question, but just for your comfort, we have written it down. Second question is really a great question. We have to do it in the class. Come on. Second question, really a great question. Come on. Sir, what it says? A company has book value per share of rupee 137.8. What is given to me? What is given to me? The book value per share of a company. Sir, book value of per share, do you able to recollect? Are you able to recollect? Yes, sir. The total equity shareholder fund divided by the number of share, which means as per the balance sheet, what is the value of every one share of the equity? Fine, sir. Its return on equity is 15%. If book value per share has been given, if ROE has been given, fine, it follows a policy of retaining 60% of its earning. It retains 60% earning if the opportunity cost of capital is 18%. What all has been given? Book value per share given. Return on equity has been given. The retention ratio, the retention rate 60% is given, which means the payout rate would be 40%. And sir, opportunity cost of capital, which is people in the class, nothing but opportunity cost of capital is nothing but the required rate of return to be used as KE. But sir, cost of equity? Sir, cost of capital is the cost for all the capital providers. Cost of equity belongs to only equity. Imagine or assume that my entire capital has no debt, no preference. It only has equity. So in that case, do you agree my cost of capital will be cost of equity? So maybe the question has given the cost of capital because it is all equity, which is why it can be used as cost of equity, because otherwise you cannot use cost of capital in place of KE. It is only with this assumption you can do it. Perfect. Sir, what is the price of the share today? We have to find out the price. Given the data, let's first of all identify which model will you apply. Is it the constant dividend model, D1 divided by K you will apply? Or it is the Gordon's model, which is D1 divided by K minus G you will apply? So it depends. Is the growth given to me? No sir, not directly. Is the growth calculatable? Is it calculatable? Sir, if I have been given ROE and if I have been given the retention rate, ROE of 15% multiplied by the retention rate of 60%. So 15 multiplied by 60% give me 9% growth rate. Since the information or the details to calculate growth has been given, I have to assume a constant growth model, Gordon's model, and apply this formula. Fine, sir. So I have the growth ready with me. I have the cost of equity of 18% ready with me. All I need to find is D1. I am giving to every live and recorded student this classwork challenge that can you apply your brains and figure out the amount, the value of D1, please. Waiting for your responses. Give me the value of dividend, whatever you are able to calculate, whether it is D0, D1 doesn't matter, but can you please try to do it? Is the classwork challenge I want to give to every single student, please, people in the class. Please. Try to apply your brains. Try to figure out what data is given. We need to evolve. Each one of us need to evolve in terms of how we think. So come on, please do it. Wait. Sir, let's try to think it together. If I have been given the book value per share, and if I have been given the return on equity, sir, using book value per share and return on equity, can we calculate something? Yes, sir. Yes, sir. Sir, whenever question gives you any data, right? And if you're not sure, I'm trying to teach you how do you approach a question. Suppose you get a new question in the exam. I'm trying to teach you how do you approach a new question. That is what also particularly we will learn in this class. Sir, suppose book value per share and ROE has been given. If you're not sure, try to figure out if any of these two things has a formula. For example, does ROE has a formula? Yes. Is book value per share is being used in that formula? Yes. So what is the next number you'll be able to calculate using it? For example, we are solving now question number 2, right? On page number 1. What it says? What it says? Sir, I know, for example, first of all, I'll say calculation of earnings per share. How do you calculate? So I know that, sir, ROE is nothing but EPS divided by book value per share. Perfect. Sir, ROE, which is right now 0.15, is equal to amount of EPS divided by book value per share is 137.8. So accordingly, how much does your EPS become? Sir, 137.8 multiplied by 15% or multiplied by 0.5. So it is 20.67 rupee. 20.67. Now I will calculate DPS. But sir, of which year? Sir, in the absence of information, I assume the dividend to be dividend of year 1 is what my point is. Do you remember me saying if the question is not clear, suppose you calculate dividend using EPS. Whatever dividend be calculated will be assumed as the dividend of year 1, not year 0 is my point, because that is what institute has been assuming for most of its question. So can I say DPS 1 will be whatever is the EPS into 1 minus retention ratio. Sir, EPS is 20.67 multiplied by, sir, what is my dividend payout ratio? 1 minus 60%, which is retention ratio, is my payout ratio. Or one second, rather than writing 1 minus retention ratio, you can write down payout ratio, so that you can automatically connect that 1 minus 60 is the payout ratio. So 20.67 multiplied by 40% give me 8.268. 8.268 rupee. With this, I will teach you one more thing about the rounding off rules. So initially, people, you not only learn the concept, initially you also learn the presentation, initially you also learn the calculation tricks, initial chapter you also learn the rounding off rules. When you get the comfort over the first 3 things in the first 5 to 7 lectures, then you focus corely on the concept, because other things you are anyways comfortable. What I'm trying to teach you, the next thing. Sir, something is 8.268. Is there a, should we make it 8.27? If the question says round it off to 2 digits after the decimal point, you rounding off to 8.27. If the question does not say anything, then you continue it to the natural number. Suppose if you calculate it naturally, it turns out to be 8.26, continue with it. If it naturally turns out to be 8.268, you continue with it. Even if it is 4 digits after the decimal point, 8.2685, you continue with it. However, if the number is really extended like 8.2685795432 something, then obviously there's a need of round off. Then if you round it off, so if there is a need of rounding it off, then you round it off till 2 digits after the decimal point, because generally all the amounts which are in rupee and dollars will be rounded off to 2 digits after the decimal point. If there is a need to round off, if naturally something is turning out to be till 4 digits or 3 digits after the decimal point, there is no need to round off, is my point. However, if there is a need, you will round it off to 2 digits after the decimal point. So 8.268 become 8.27 rupee as my EPS. This particular rounding off rule, people in the class, could I convey to you? Please tell me. Please, please, please tell me. Come on, super fast. If we want, we can write it down here. Since the number is naturally till 3 digits after the decimal points, therefore, there is no need to round off. So initially you will end up writing these notes so that you get a comfort that if you revise, even if you revise the things after a year or so, you are able to recollect everything. People, are we all set? Are we all set? So we have now the number of DPS. So finally, if you have DPS ready, now we need to calculate the growth. Growth is equal to retention ratio multiplied by ROE. Sir, what is my retention ratio? 60%. You retain 60 and of that, how much you earn on that? Sir, 60% on 50% turns out to be 60 multiplied by 15% turns out to be 9%. Now, finally calculating the price of share. Price of share, which is P0. Sir, how can examiner ask me to calculate the price? Price is something which prevails in the market. What we calculate is called as equilibrium price or intrinsic value, but never the actual market price. Agreed. But imagine the share to be fairly valued. In that case, can I say the price in the market is same as what according to us is the intrinsic value? So one and the two words, which is intrinsic value and the price, can be interchangeably used, which is why it has asked you to calculate price, which is using Gordon's model D1 divided by K minus G. Do we have the D1 ready with us? Yes, dividend of first year automatically assumed first is 8.268. If we want, we can write down one more note here. In the absence of clarity, dividend is assumed to be of year 1. People, do you believe in writing down these notes or not really? What is your approach? I mean, I feel that whenever there is a situation which can create lack of confidence or create confusion on a later point, all those things should be written down here. What do you all say? What do you all say, everyone? Do you people find it a need of writing it down or not really? Agreed. So D1 divided by K minus G is the formula. So 8.268 divided by cost of equity directly given by the examiner as 0.18 minus growth given by the examiner as 0.09, calculated by us as 0.09. So rupee, what will be the price of share? 8.268 divided by 0.09 is 91.866666, which is 91.87 on a rounded off basis as the price of share. 91.87 is the price of share. Pause. Do we have the answer, please, to the second question? Please tell me. Are we all ready? Are we all set? And also, are we comfortable on how do we present the things to the examiner? These notes are just for your reference, not for the examiner. To the examiner, you have to show what is there in the blue ink. If you people have gained that comfort, can we now slowly, gradually speed up? Yes, no? Can we now gradually speed up the things? What do you say? So question number second gets done. Third question is an extremely easy question. You'll have to do it at your own, which is homework. And it being a homework question, You don't have to do it in the notebook. It's so simple that even in the homework, you have to do it only on the calculator. Only on the calculator, nothing else. Sir, question number 4 is a good question. We will do it in the class, right? But on the calculator. You will have to do this question at home by writing it down. Yes. So the point is that unless I tell you the question is on the calci, all other question has to be compulsorily in your notebook. Unless the question I mark it as calci question, all other question has to be in the notebook. If we do it in the class, great. If we don't do it in the class, you will have to do it at home, is the simple point. Yes. So perfect people, question number 4. Let's start to read. It's an easy question. We will do it in the class. The presentation of it you will do at home. Following are the details of X limited and Y limited. What are the details? What are the details? People, just a small feedback. The way we are doing the questions, the way we are interpreting the question, the way we are presenting it, are you people comfortable? I mean, this is the first question we are doing, right? Which is why I need to ask for your comfort. Are you people comfortable? Can we continue to follow the same approach, same way that we are doing it? What do you say? Come on, people. Yes, we follow the same flow, same rhythm. Following are the details of X limited and Y limited. There are two companies. If I talk about the dividend per share, it is 4 rupee for both the companies. Sir, dividends are same, but this is to be the dividend of which year? Year 0 or year 1? In the absence of information, we assume the given dividend to be of year 1. Fine. Growth rate of the two companies are same 10%. The betas of 2%, two companies is 0.9 and 1.2. The market price currently is 150 and 70. So two companies having same dividends, having same growth rate, but the different betas, right? Risk-free rate 7%, market rate of return 14%. Let's, before solving, analyze the question. Let's mentally evolve ourselves. People in the class, I'm throwing to you some questions which you will have to think and answer. Can you please try to think, not calculate, just think which of the two companies will have a higher cost of equity? Which of the two companies will have a higher cost of equity, X limited or Y limited? Sir, common sense. RF plus beta into RM minus RF. RM and RF are common for both the companies. The only point of difference is beta. Company Y limited has a higher beta, which is why it will have a higher cost of equity. Next question. If the dividends are same, if the growth of the two companies is same, but K are different, will the value of two companies be different? Obviously, yes. Because in my entire formula, there are three variables: dividend, cost of equity, growth. If cost of equity is different, then the answer will be different. Which of the two companies? Dividends are same. Growth is same. K are different. It has a higher K, it has a lower K. My question to you is, which of the two companies will have a lower intrinsic value? Try to apply your brains. Answer me this question. Which of the two companies will have a lower intrinsic value? Recorded people, even if your answer does not reach to me, you'll have to think and evolve. Please. Let's make our brain habitual of thinking. That is what finance is primarily about, to be able to think, analyze, evaluate. Shruti thinks Y limited will have a lower value. Harshita thinks it is Y limited, is it? Sir, you can apply common sense. My future cash flows are same. I have to discount the future cash flow. The company whose discounting rate, which is KE, will be higher, will have the present value, which is lower. This is one common sense. Another common sense is to use the formula. Sir, dividends are same, growth is same. The company whose K will be more, the denominator is bigger, the overall answer is a lower answer, the present value will be a lower value. That's what the logic is. So question number 4, let's first of all calculate. People in the class, such an how many of you feel that this question should be a classwork question? Come on. Or let's do it in the classwork rather than discussing it. Let's first of all calculate KE. Sir, RM is 14, RF is 17. So RM minus RF is 7. So 7 RF plus beta of 1.2 into RM minus RF of 7. 7 into 1.2 plus 7 give me 15.4 as the cost of equity of Y Limited. 15.4. Similarly, for X Limited, what it turns out to be, please calculate and give me the answer of cost of equity for X Limited. Super fast. Come on, come on, come on. Have the answer ready. No scope of discussion here. 7 into 0.9 plus 7. Are you people getting 13.3 as the answer of cost of equity? If you have the two cost of equities with you, the two B1s with you, the two growths with you, let us calculate the intrinsic value. I am doing Y Limited, you are doing X Limited. Please. Your cost of equity was 13.3, my cost of equity was 15.4. Let's do it. $129.6296, which is 129.63. Wait, where is the mistake? Sorry, 74.074074, which is 74.07 is the price of share, or we can say value of share, the intrinsic value according to the Gordon's model. This presentation has a mistake. It missed to write down the formula, which you will have to write down. Please understand. You'll have to always write down formula. So please add it here. Please add it here. You have to write down formula as D1 divided by, or maybe you can do one thing. You can write down the formula here so that it becomes commonly applicable. You can write down the formula here also. This presentation will also work. Writing the formula here, applying directly the numbers in respective column. Do you people have the value ready? Boss, the value, is it ready? 4 divided by 0.033 gives me 121.21 as the value of share. The first part of the question is calculate the price of the company. Fine. Second part, comment on the valuation on the basis of price calculated and the current market price. The current market price is 150. The price that we calculated is 121. Answer my question in true or false. Since price that I calculated is less than the price which is there in the market 150, I can say the share is undervalued and I should buy it. True or false? The price that I calculated is less than the price which is there in the market, which is why share can be said to be undervalued and I should buy it. True or false? Every single student will have to think and answer to this question. Come on. Come on, come on, come on. Please. Waiting people for your responses. Have you all thought? Have you all thought? So those live people who are lagging behind, please come to the latest point. Shruti and Harshit, are you all able to think what is going on? Sir, the point of learning here was I am trying to purposefully confuse you people. Sir, why? Sir, please remember, I'll take you to the out notes and mark you people out there that you have to always comment on the share price. There are two things here. One is MPS, another is intrinsic value. You have to always comment on MPS. If MPS is more than intrinsic value, you call the share to be overvalued. You don't have to comment on the intrinsic value that if the intrinsic value is less than MPS, then the share is undervalued. No. What is there in the market, you actually comment on it. Let me explain it to you in a simple example. For example, you went to the market and you realized you liked Nike, or for example, Apple iPhone. Forget Nike shoes. You found Apple iPhone is there in the market, which is worth 1,50,000, which has a market price of 1,50,000 on Flipkart, right? When you look at the price of 1,50,000, what do you comment? Do you comment that the price in the market is really more? It is over expensive, the Apple iPhone? Or do you rather comment that price in my mind is really low, it is an undervalued phone? What do you comment? Think practically. Do you comment that the price of iPhone in the market is really high, it is overvalued? Or do you comment the price in my mind is really low, it should be really low, it is undervalued? What do you comment? Think and tell me, please. You always comment on the price which is actually there in the market, that actual is over or actual is under, because you can buy or sell at that actual price, not at the price which is there in your mind. Could you understand this particular thing? You always comment on the actual thing by comparing it with the intrinsic value or the fair value which we calculate, which is in our mind. Do you agree to it? So with that mindset, you have to always comment on the MPS. If it is more or less, this is such a basic thing which I thought you knew, but I found that there's some confusion, which is why price in the market is 150 and the intrinsic value is 121.21. Now, can I say in the B part of this question that since MPS in the bracket rupee 51 is more than the intrinsic value in the bracket rupee 121, therefore share is overvalued. In the third part of the question, they are asking what should be the course of action to an overvalued thing we sell. Similarly, in the for second security, price in the market is 70, which is less than the intrinsic value of 74, which means share in the market is undervalued and we should buy the share. Could you all please comfortably understand it? People. Question number 4. What is the state of comfort? Quick, yes, no. How much out of 10 are you people comfortable on question number 4? Please respond to me at this particular point. Shruti, Harshita, other live and recorded people sitting here, was that a point of clarity that we discussed that you have to always comment on the actual market price? Or that was quite obvious? What do you say? Was that a point of clarity or was that obvious? If that was a point of clarity, you will have to write it down, is my point. If it was a point of clarity, you will have to write it down here so that you remember it when you revise it. As I said, your outnotes are going to be a Bible. Today, everyone, we learn it. Today, we write it down such that on the day of exam, you have all the confidence on this book that, okay, this book has everything that I need for exam, that I need for solving any practical question. Okay, which is why you have to understand that the way we are learning the things is really time consuming. Why? Because we end up writing so many points of minuteness which will avoid your confusion on the day of revision. It will eliminate all the confusions. Sir, for that, if we have to write down the notes like this, we do write. If we have to upgrade the concepts based on the learnings of the question, we do it. For example, we just upgraded a concept that we have to always comment on the actual price, not the intrinsic. Comment on the actual price. Fine, great. So sometimes students tell me, sir, why do you not do these questions in the class? Two reasons. It is only when you do it at your own, you have a better learning. Right? If I make you do it, you will never think of those points when you do them at your own. So please understand, since we have done it in the class once by writing it by on the calci, we have done it once. So now when at home when you do it, you will have to do it by not looking at the solution but by solving it at your own. This will automatically give you a greater level of comfort on AFM, that I can bet. So basically you are doing your first revision along with the classes if you realize. That is the first reason why I make you people do it. Second reason, I know that this is something you can do at home, but clarity of concept is something you cannot do alone. For that you will need my help. For example, writing down this particular thing, or for example, writing down this particular thing, or for example, writing down this particular thing. So we focus more on the things for which you need my help, particularly like writing down these things. So we spend more time on bringing the conceptual clarity, the comfort on a question or the subject, and less time on doing repetitive thing. For example, solving this question is a repetitive thing. This is something you can do at home without my help. But writing these specific notes, you will need my help, which is why we write down these notes in class. Are you people comfortable with the approach? Are you people comfortable with the approach? Please tell me. Come on, come on, come on. Question number fourth, you will do at home on notebook. Question number fifth, we do in class, but that is a only on calci question. People, please respond to me. Are we guys aligned? Are we comfortable with the approach? Question number fifth, we do, but only on calci, which means at home you don't have to do it in the notebook. It will remain on calci. It is such an easy question that presentation is not a big deal. You just have to need to comfortably solve it once on the calci. The following information is collected from the annual report of J Limited. J Limited is a company. From its annual report, some information has been collected. What is the information? Profit before tax is 2.5 crore. Tax rate is 40%. Retention ratio is 40%. Sir, on this profit, company they pay 40% tax. Whatever is the PAT company gets, it retains 40%. The outstanding share is 50 lakhs. Equity capitalization rate. Sir, what does it mean? What does the word equity capitalization rate means? Sir, it is key. So can we please go to the outnotes once and write down, which is why we want to be 100% clear about things, that sir, K is also called as equity capitalization rate. It is also called as equity capitalization rate. So that when you are revising, you are automatically comfortable with both the terminologies, even if you don't, also called as equity capitalization rate. Even if you don't revise this particular question, it is fine because you have that thing written over there in terms of concepts. Perfect. So equity capitalization rate 12%, rate of return on investment. Sir, is ROE and ROI two different things? Are the two things different? Please tell me. ROI is the return. People, let me explain it to you first, then you write it down. Okay, let me write it down, then I will explain. In fact, let me explain first. ROI is the return on investment. It includes the amount of both debt and equity, right? So ROI is the return calculated on the capital invested by both debt and equity, where ROE is the return calculated only on the capital invested by equity. Full stop. Assuming there is no debt, we can consider ROI equal to be equal to ROE. Just 1 second. I will explain it to you now. Give me a minute. You all tell me one thing. ROI, people in the class, look at this. These are certain questions which are otherwise really basic. But these questions try to teach us something which we all should remember. It may be applied to some other question. Sir, ROI, are the two things equal? No. ROE, where is the investment, is the return on investment of only equity. ROI is the return on investment of all the capital providers, debt, equity and preference. Fine. Which means 15% is what I earn when I invest the amount of all of them, which means it is not ROE. But let's assume that my capital structure has only equity. Don't focus on writing it down right now. Please understand. You have to first understand what I'm saying, then you write it down. Let's assume that my business has only the amount of equity which is invested. Then can I say that if I have only equity invested in my business, then whatever return on the investment of equity will be ROI as well as ROE. Could you understand what I said? People in the class, please respond to me once on this, then you write it down and then we solve the further question. Come on, first share your comfort with me. Could I explain how is ROE and ROI also? Super fast, quick, yes, no? Please. Yes. So quickly write this down. Let me know when you have written it down. Shruti, isn't it that you write really fast? Harshita, are you done? Other like people sitting in the class, are you people done writing? Let me know, I'm waiting for you. Yes, done. So recorded people, we are proceeding ahead. So we have basically ROE, we have basically KE, we have the retention rate, we have PBT, we have number of share outstanding, we have tax rate. We have to find out the market price per share according to Gordon's model. How many of you feel looking at the question that said this question is doable? Super fast. Except for this particular point where I had to explain, everything else can become a homework. Depending upon your confidence, we will decide whether we do it in class or at home. It will be a calci question only. No need to do it in the notebook. Question is how many of you feel that you can do it at your own. Come on, super fast. Question number 5. Based on your answer will be, based on your answer will be my plan of action. Do you people feel confident of doing it at your own? Come on, what do you say? I'm sure a lot of people would be watching Theory Marathon today since they have exams. If you allow me, can I put up a message on the Telegram channel for these people? Just give me a minute. Just a minute. Just send it. Harshita thinks you can do it at your own. Shruti thinks, sir, it should be classwork. So Shruti, super fast get started, right? Was just sharing that people you can started watching Theory Marathon. Exam day morning, the best thing is to do the Theory Marathon. Theory Marathon is available in both the languages, for English and Hindi. So for you people as well, I'm saying, on the day of exam morning, do the theory at your own or start watching the marathon which is already available, right? So anyways, sir, let's do it on the calci super fast. Sir, if I have the amount of PBT, profit before tax, can I deduct the tax rate from it, tax from it to find out PAT? Yes, sir. 2.5 crore minus 40% give me a PAT of 1.5 crore. When that divided by the number of share of 50 lakhs divided by 50 lakhs is 0.5 crore, give me the EPS of rupee 3. Earnings per share of rupee 3. So if I have the EPS and if I have the retention ratio of 40, which means payout ratio of 60, can I have the amount of dividend? 3 multiplied by 60% give me the amount of dividend of rupee 1.8. So I have the D1 divided by K is given to me as 0.12, 0.12 is the equity capitalization rate KE minus growth. So retention rate into ROE is growth. So 40 is the retention rate multiplied by 15% is ROE. Of ROE give me growth of 6%. So 1.8 divided by 0.12 minus 0.06. So 1.8 divided by 0.12 minus 0.06 is 0.06 give me 30 rupee as the value of share as the market price as per Gordon's model. Yes, this is how we do it. I was being really fast while solving it because I found the question to be easy. Could have been in homework, but it's a midway. Faster classwork or homework? Quick. Are we set? Yes. So question number 5, people in the class gets done. So now we're gonna do further question, but before that we'll take a break. Set are we? Can we proceed to take a break? So it is 9:50 right now. When are we meeting back? 10-minute break sufficient? What do you say? 10 minutes sufficient? Can you all please be back by 10 a.m.? Come on, will that do? Shruti and everyone. Yes, please. So please be back by 10 a.m. Alright, 10-minute break. See you all after the break. Yes, people, are you all back? There? There, everyone. Back from the break. Shall we proceed? To question number 6. Shall we start? This particular question, question number 6. So let's people in the class start to read this question. What it says? It says that shares of Voyage Limited are being quoted at a P ratio of 8 times. Quoted at a P ratio of 8 times, which means what is the formula of P? The formula of P is MPS divided by EPS. So when I say that the share of this particular company is quoted at rupee 100, so I am telling about the market price. But P ratio depends on the market price, which is why we say it is quoted at a P ratio of 8 times, meaning to say whatever is its EPS, that multiplied by P ratio give me the MPS. Correct? So if you use the quoted word with the market price, therefore similarly you can use the quoted word with the P ratio. So it is quoted at a P ratio of 8 times. Fine, sir. Company retains 5 rupee per share, which is 50% of its EPS. Retention ratio is 50%, which is rupee 5. You are required to determine cost of equity of the company if the market expects growth rate of 15%. First thing you have to calculate is cost of equity. All of you have learned that the first approach to calculate cost of equity is RFRM beta approach. Do we have the details of RFRM beta? No. The second approach is Gordon's model, which is D1 divided by P0 plus G. Given this information, how many of you feel that Gordon's model can be applied? Come on. All the live people, all the recorded people, please tell me, given this information, how many of you feel that Gordon's model can be applied? Sir, do we have the information of dividend? Do we have the information of price? Let us figure out. If I have been given the P ratio, PE multiplied by EPS give me MPS. I know PE is nothing but MPS divided by EPS. So if I have the P ratio of 8 times, if I can somehow have the EPS, I'll be able to find out MPS, which is P0. Sir, I have been given the retained earning of 5 rupee. I've been given the retained earning of 5 rupee, which is 50% of my EPS. So I know retained earning is equal to EPS multiplied by 50%. So if this is 5 rupee, can I find EPS? Yes, sir, EPS will be rupee 10. Of that EPS, if retention ratio is 50%, which is 5 rupee, then rest of the 5 rupee is the dividend amount. So dividend of 5 is clear, EPS of 10 is clear, P ratio of 8 times is clear. That's how MPS is clear. Are you understanding how is different data available to me where growth of 15% is 0.015 is directly given to me? Shall we all proceed to solve this question in the notebook? Question number 16. So super fast everyone, come on in the class. Solving it in the notebook right now. Question 6. Question 6 must be page number 2 of your notebook or 3 of your notebook, that you figure out at your own. 3 of the notebook, of which we have to first solve part number A, calculating cost of equity. So first of all, I will have to say retained earning is equal to rupee 5 per share. Retention ratio is equal to 50%. So EPS is equal to retain earning divided by retention ratio. In fact, these are not even official formulas. It's okay if you not write down the formula here. It's like 5 divided by 50% is equal to rupee 10. So if EPS is clear, dividend at the end of first year will be 10 rupee of EPS. Either you can say multiplied by 50% or minus retention ratio of rupee 5. Retain earning of rupee 5 is equal to rupee 5 of DPS. In fact, let me teach you one more thing here. Sir, when you are making a calculation, it's okay if you not write down the rupee. For example, 10 minus 5, it's okay if you not write down the rupee, but ultimately when you write down the final answer as 10 minus 5 is equal to 5, that is when you have to put a currency or a unit or whatever to it. That is what you need to understand. It's not needed to write down rupee 10 minus rupee 5 is equal to rupee 5. You can simply write down as 10 minus 5 is equal to rupee 5 as your DPS. So DPS is clear. Now can I say MPS is equal to EPS multiplied by P ratio? Yes sir. If my EPS is rupee 10 and P ratio is 8, my MPS everyone is rupee 80. So P0 is there, D1 is there, plus growth is there. So can I say KE is equal to D1 divided by P0 plus G. D1 is 5 divided by P0 is 80 plus the growth rate of 0.15 give me overall answer as 5 divided by 80 plus 0.15 as 0.2125 or 21.25% as the cost of equity. People, cost of equity KE. Comfortable on this? Everyone, please tell me. Comfortable on this? Cost of equity 21.25. Right? There is a possibility you might find some difference in the presentation as compared to what is already there in the book or what is there in the notebook. In case of discrepancy, you will have to follow what is there in the notebook. Perfect. Please let me know when you have written this down. Please let me know when you have written this down. Just a second. Cool. Done. So A part of the question gets done. What about part B? Second part of the question says the indicative market price you have to calculate with the same cost of capital and the growth rate is 16%. Sir, cost of capital you just calculated 21.25. Let's assume the same cost of capital, cost of equity. Perfect. Growth rate changed to 16%. Calculate the indicative market price, meaning to say calculate the fair price. Calculate the fair price. So to be able to apply to calculate the fair price, I need to apply Gordon's model D1 divided by K minus G. Do I have the D1 ready? Yes, which is rupee 5. So B part of this question, calling it as indicative market price is equal to D1 divided by K minus G. I have 5 rupee as the D1, 0.2125 as the K minus 0.06 as the growth. How do you calculate 0.2125 minus 0.16 M plus? 5 divide equal to, 5 divided by memory recollect is equal to 95.24 rupee 95.24 as the answer of indicative market price is the answer confirmed. Did you understand the calculation that I did on the calci? Really easy. Sir, 0.2125 minus 0.16 is equal to is the denominator. I can put it to the memory so that, or I can rather do divide equal to multiplied by the numerator of 5 is 95.23, it is 24. C part of this question, what it says? It says the market price of the company cost of capital is 20 and the growth rate is 18. I mean, there's no point of doing it again and again. C part, you may do it only on Cal C. Come on, C part. Do it only on the Cal C. So 5 divided by 0.02 is basically 250 rupee. K is 20, G is 18. So 5 divided by 0.02 give me 250 as the share price. Third one, and extremely easy. Question number 6 overall gets done. People, no point of solving the same thing again and again as kids. Absolutely no point. Are we set? Shall we proceed to the next question, which is question number 7, which I can say is really a great question. Question number 7. Come on. Question number 7, if I talk, people, just 1 second. Question number 7, which we're gonna do in the class, has multiple answers, means has multiple alternative answers. Of all those multiple answers, we are doing in the class the one which we find the most logical and which we find the most easy. Perfect. So 7th question, it may happen that in some other book you may find some other answers also. So don't assume that their answer is incorrect or our answer is incorrect. Both may be correct because there are multiple answers, right? So I will never include 2 alternative answers in the outscanner just to make you people confused. If one answer which we feel logical is there by institute also, we take that particular answer in the outscanner, no other answer is included. Am I clear? So transparency is really important for you to understand what's happening. So let's start to read question number 7. Risk-free rate is 9%, right? Needless to mention, per annum. Expected rate of return on the market RM is 13%. So RF is there, RM is there. Expected rate of growth of dividend. Dividends growth has been given as 7%. Last dividend paid D0 has been given 2. Beta has been given 1.2. Sir, part A of this question, calculate equilibrium price. How many of you people in the class can calculate equilibrium price? Come on, tell me. Question number 1, if I see, is exactly the same question, right? Is literally the same question, has no difference. Cool. So I will merge now in the next batch question number 1 and question number 7. Cool. Question number 7, super fast, in the class right now. Question number 7. In the class right now. Let's solve it on the calci first, then we will figure out if we should write it down in the notebook now or you will write down at home. Sir, first part of this question, calculate the equilibrium price. I need D1, I need KE, I need G. Sir, do I have the D1? Sir, D0 is there as 2. Using the growth rate of 7%, I can calculate D1. Fine. KE, is it there? Sir, beta is there, RM is there, RF is there. So let's first of all calculate KE. So 13 minus 9 multiplied by 1.2, 13 minus 9 multiplied by 1.2 plus 9 is 13.8. 13.8 is the KE. So if you have the KE, if you have the growth, if you have D0, can you apply the Gordon's formula? Yes, sir. 2 plus 7% is D1 M plus. So 2.14 M N plus. KE minus G. 0.138 minus 0.07 is equal to denominator of K minus G of 0.068. Divide equal to multiplied by memory recollect of 2.14 give me 31.47 as the answer to this particular part of the question, part A. Market price or the equilibrium price. Could you all understand how did I do it on the calci? I purposefully do it fast sometime so that you start to get that comfort on the discomfort. What did I do here? Sir, first I did the numerator, put it to m plus. Then I did calculate the denominator. Then I pressed divide equal to multiplied by memory recollect which is there in the memory. The numerator which is there in the memory multiplied by memory recollect give me the answer. So 0.138 minus 0.07 is equal to 0.068 in the denominator. When I press divide equal to, basically I have solved 1 divided by 0.138 minus 0.07. So I need to simply multiply the numerator to it. So multiplied by 2 multiplied by 1.07 is 331.47 as the answer. Please observe one more particular thing. If you have capabilities to solve it directly on the calci, there is no need to show sub steps. There is no need to first write down 2.14 as the numerator, then 0.06 as the denominator. No. Examiner will not allot you marks for the sub steps. Right from here to directly here, examiner is going to give you marks. Am I clear with this particular exam tip also? Although you will get these exam tips towards the end of your exams, right? But as of now, are you people clear? Come on, super fast. 31.47 is the answer. Ready? Live people sitting in the class. The second part of this answer. How would the equilibrium price change? How will this price change when? First, inflation premium rises by 2%. What a beauty. Question says inflation premium rises by 2%. Expected growth rate increases by 3%. And beta rises to 1.3. So right now beta which is 1.2 will become 1.3. First thing, inflation premium increases by 2%. So let's get to the basics. Do you agree? Any nominal rate which is given, any nominal rate, whether it is risk-free or it is risky. Risky means any return from a risky asset. For example, market is also risky. Stock market, is it risky? Yes, sir. Every security other than government bond is risky. So whether the return is risk-free or the return is risky, inflation premium is a part of it automatically if it is nominal. Inflation premium is a part of it. So if inflation premium increases by 2%, RF will increase by 2% and RM will also increase by 2%. This is the clarity of concept I want to deliver to you. Are you people please agreeing to it? Yes. If you want, we can give the reference of this particular question number 7 also. You can write down question 7 of equity business valuation. Not compulsory, but if you feel like giving a reference, you can give a reference to it. Yes. So in question 7, what we have learned that if inflation premium will increase by 2%, the RM of 13 will become 15 and RF of 9 will become 11. So revised RM 11, revised RF 15. Beta revised is 1.3. So what will my revised KE be? 15 minus 11 multiplied by 1.3 plus 11 give me revised KE of 16.2. Revised KE of 16.2. Now dividend which was paid as 2 into growth will increase by 3%. So from 7 the growth will become 10%. So 2 into 1.1 divided by 0.162 minus 0.1 which is 10% of growth. Can you all please calculate using these revised parameters? If all these parameters change, growth become 10. Beta become 1.3, accordingly KE becomes 16.2. Can you please give me what does the revised share price equilibrium price become? So 2 plus 10% is M plus, then 2 plus 2 plus 10% is m plus. Then 0.162 minus 0.1 is equal to 0.162 minus 0.1 is equal to 0.0262. Divide equal to into memory recollect give me 35.4838, which is 35.48 as the answer to this particular part, rupee 35.48. Everyone. Question number 7th gets done. In the class, we have done it on the calci. I mean, do you people realize when we understand something on the calci, there is no compromise at all in this. We learn every possible minuteness of it. Only thing is that at home you will have to do it once more for the sake of practice. For writing it down in the notebook, you cannot avoid writing it down, because if you avoid it today in the exam hall, you will never be confident of solving the paper. Boss, question 7, will you be able to do it in your notebook? What do you all say? Come on. Question 7, will you be able to do it in your notebook? Super quick, yes, no, what do you all say? Question 8 is the next question we will do. Is a brilliant question, question number 8. We all proceed ahead. So come on, we are starting to solve question number 8 in the class. Come on. X Limited just declared a dividend of rupee 14. Just declared obviously give us the clarity of D0. There is no scope of assumption as whether it is D0, D1. It's clear D0. Mr. B is planning to purchase the share. Fine. Anticipating increase in growth from 8 to 9. The growth will become 9, which will continue for 3 years. Fine. He also expects the market price of the share to be 360 after 3 years. Sir, what is happening? Let's try to understand. Just give me a minute. Just give me a minute. Sir, in this case, do you observe something? Sir, you can mark question number 8 of a variety where share is not held for indefinite years of time. Sir, share is planning to be held for a limited period of time of 3 years, because at the end of 3rd year, what is going to be the selling price that has been given to me? Are you understanding how is this particular question different from any other question? So you can mark question number 8 of outnotes to be the question of this category. Which category? This category here. So let's make sure that we mark all the question in pink now. Question number 8. I have marked it in the outskirts that this question belongs to this particular category, where I have to discount the dividend for the holding period, whatever I receive. Then I have to discount the selling price that I will receive at the end of the holding period. Logical? Perfect. The maximum amount Mr. B should pay for the share if he require a rate of return of 13%. If we require to earn 13% rate of return from the share, which is going to give dividend of 14 rupee plus 9% for the next 3 years, and at the end of 3rd year he is expecting the price of the share to be 360, what is going to be the price today? We have been given at a discounting rate of 13%, we have been given the present value factor. So common sense, present value of future cash flow. Question number 8 in your notebook. Question number 8, page number which one? 5. Question number 8, page number 5. Value of share is equal to present value of dividends plus present value of selling price. This is something, even if you don't write is okay, but writing gives you a sense of what you are doing, right? For example, sir, how much is the present value of dividend? Sir, let's first of all try to calculate the dividends. Have we been given the future dividends? Sir, I have been given D0, right? In fact, if you want, so let me explain to you both the presentation here. All the live people, all the recorded people, listen to me. We have an option to make both the kinds of presentations. Fine. Sir, presentation number 1, which is in terms of formula. Presentation number 2, which is in terms of table here. Let me try to first of all show you the formula presentation. Okay, just give me a minute. Let me rectify it a bit. Just 1 second. Because I need some space to write it down. So it will be D1 into present value factor of first year, right? Plus D2 multiplied by present value factor of 2 years plus D3 plus sales price at the end of third year multiplied by present value factor of third year. Correct? Please don't write it down for a moment. Let's try to understand what is going on. Then the presentation which we decide is better for you, that is one we will write. Don't write it down right now. Sir, have we been given D1, D2 and D3? No, sir. We have been given D0. Where is that? We have been given D0. But with the 9% growth rate, what should be? The future value factors that has been given to me. Perfect. So can we calculate it first? Yes. So one possible presentation, although institute has nothing to do, whatever you present, institute will give you marks, but still, let me tell you. So 14 is D0 multiplied by 1.090 is D1 whole multiplied by present value factor of 0.885. So basically this particular terminology is this and this particular terminology is this. Someone is saying, sir, वैसे तो syllabus 3 बार revision कर रखा है, but कल सारे question नए लग रहे थे. Don't worry, don't worry. When you go to the exam hall, you'll be able to recollect the things. Don't worry at all about the things because you have revised it so much that go to the exam hall with the calm, with the relaxed mindset. You'll be able to recollect the things that I can tell you. Okay? Yes. So people in the class. Okay, fine, cool. Do those RTPs, MTPs. Theory, are you done with? Have you started? Are you done theory? Have you started doing it? Just 1 second. Come on. Shall we all do it? Yes, sir. Sir, what is my D2? So basically try to understand if my D0 is 14 rupee. With the 2 years of growth, it become 1.188 times, which means it is the future value factor, means the growth factor of 2 years. So plus 14 rupee of D0 multiplied by 1.188, make it the dividend of second year, multiplied by the present value factor of 783, make it the present value of dividend of second year, plus, right? Next, let me take it down to the next line, plus Sir, dividend of third year is 14 multiplied by 1.295 plus what is the sales price at the end of third year? 360, right? So this is the total cash flow I will receive at the end of third year multiplied by the present value factor of third year as 0.693. This is the present value. So using that, what is the total value of the share today? The total present value, let us calculate. 14 multiplied by 1.09 multiplied by 0.885 m plus 14 multiplied by 1.188 multiplied by 0.783 m plus, then 14 multiplied by 1.295 plus 360 whole multiplied by 0.693 m plus memory recollect is 288.5720, which is 288.57 on a rounded off basis. So you have two choices of presentation. Choice number one, calculate the future dividends of next 3 years. Ignore this one now. Calculate the future dividends of next 3 years like this. Then discount those future dividends in a tabular format, or rather than creating a table, you can apply the formula here. The choice is yours. Or you can directly do this. What do you want to do? Please tell me. Accordingly, we will proceed. In my opinion, after doing all this, what I feel is that you should first find the dividend for the next 3 years. In your notebook, how should the presentation be? Calculating the future dividends. So first of all, you should find the future dividends, right? For which the presentation should be like, give me a moment, let me do it for you. You can do this one also directly that you are seeing in the notebook here, but just for your ease, I am suggesting you (14 multiplied by 1.09), then 14 multiplied by 1.188, then 14 multiplied by 1.295 will give you the dividend of next 3 years. 14 multiplied by 1.09 is 15.26. Then 14 multiplied by 1.188 is 16.632. Then 14 multiplied by 1.295 gives me 18.13. Let us confirm if the number is correct or not. Yes. Now value of share, you can directly use the dividends calculated above. Yes, your amount of dividend will be 15.26, 16.632 and 18.13. Even if you calculate it, answer will be same as 288.57 the way we calculated it. This to me seems the best presentation. Are you people done with it? Please do it. Waiting for y'all. So first we calculated future dividends, then we discounted the future dividends. When you people are done writing, please let me know. I'm waiting here in the chat box. Okay? Come on. Students are asking doubt. Some people are coming live and asking doubts. On YouTube, some people are messaging me on Telegram and WhatsApp. Fine. After the lecture, we will reply. So are you people there? Are you people done writing? Let me know when you are. Sorted? So assuming we are done writing, I hope you are clear with the concept of present value factor, future value factor. Yes, done writing. Are you all also 10 on 10 clear on what we have done? Not just the writing, but understanding the logic. Are you people comfortable that with the help of future value factor, when you multiply a future value factor to a number, you get the future value? So using 9% growth, what will be the future dividends that you can find? That is what we have found, the future dividends of year 1, 2 and 3. Similarly, present value factor discounts those future dividends, future cash flow to present value at the rate of 13%. So multiplying the present value factor, discount the future cash flow. All this is really extremely basic despite I thought of repeating it. First part gets done. Second part. The maximum price Mr. B willing to pay for the share if he is of the opinion that 9% growth can be maintained indefinitely and require 13% rate of return. Sir, the category of question has changed. In first part, the question belongs to the category of definite holding period, but now it has become an indefinite holding period, which means infinite holding period. Which means if I have an infinite holding period, I'll have to apply Gordon's model, right? Dividend discount model, first of all. And in the dividend discount model, with the growth rate being there, the most appropriate formula is Gordon's model. So in that case, maximum price that we are willing to pay. In fact, in the first part also we should write it down as maximum price. In the second part, again it is D1 divided by K minus G. Yes? Sir, what is D1? D1 is 14 rupee of dividend into 1.09 divided by. What is K? The discounting rate K, as they say, is 0.13 minus growth rate of 9% can be forever maintained. What is turning out to be the price? Please do it at your own before me explaining it. I mean, not just this particular question, anytime. Try to solve the things ahead of me explaining it. Come on. So 14 multiplied by 1.09 divided by 0.04 give me 38.15 rupee 38.15 per share seems to be the maximum price. Can you please confirm? 38.15. 1 second. Sorry, yeah, 381.5. My bad. 381.50. Done. C part of this question. What does question say in the C part? The price of share at the end of year. 1 second. There's some misprinting. Let me go to the study material and check what exactly is there. The exact wording. Price of the share at the end of third year. 1 second. Let me go to the study material. There's some misprinting in the outscanner. Please let me go to it. Maximum price. So from the chapter of security valuation, this is question number 5. The price at the end of 3 years. Okay. So please change it. There's some misprinting. The price of share at the end of 3 years you have to find. Clear, sorted. So what is question asking again? All the live people, recorded people, listen to me, try to do it. Sir, what is the price at the end of third year? If 9% growth can be achieved assuming other condition remaining same, which means K remaining same as 13, the growth is to be maintained for indefinite period of time, which means you have to again apply Gordon's model. Only thing is that you have to find price not at 0 year but at third year. You know what is the point of learning? When you have to calculate the price at 0 point, you have to use the dividend of first year. However, when you stand at the end of third year, when this becomes 0, so dividend of next year become the dividend of fourth year actually, if you realize. So using a price of 0, to calculate the price of 0, we use D1. So to calculate the price of third year, we need D4 divided by K minus G. Do you agree? Sir, what is the dividend of third year? Sir, we just calculated the dividend of third year to be. Where is that? 18.13. Dividend of third year just calculated as 18.13 and a growth rate of 1.09. Make it D4 divided by K of how much is the K given? 13%. 0.13 minus growth rate of 0.09. Again, can you give me the final price, people in the class? 18.13 into 1.09 divided by 0.04 is 494.04. Please confirm. Rupee 494.0425 actually is 494.04 only rupees. This become the price when at the end of third year, right? So we have to write it down in words also, because examiner may not be able to understand what exactly P3 is. People, are we guys done? Are we guys done with this particular question? Question number 8, please tell me. Are we guys done with question number 8? Please tell me. What do you all say? 10 on 10 set. Waiting for your responses. If you respond, we proceed ahead. Come on. Question number 8. What do you all say? I think you people are lagging behind a bit. Question number 9 is the next question, but I feel that we will have to consider stopping the lecture right now, today particularly, because today our AFM exam and a lot of students are asking doubts and waiting for me to respond. So are you people okay for having the lecture only for 2.5 hours today for this particular thing? What do you say? Come on. Are you set? Are you comfortable with the way we have learned the things? Yes, people. When you say yes, we call it a day. Seems there's some glitch. Perfect. So that's really great, everyone. Thank you so much for watching up this lecture. I hope the lecture has made sense. We have tried to solve in the notebook whatever questions which were needed for you to learn from presentation point of view. Other questions we have done in the combination of Calci and homework. Yes, this is the approach we are going to follow for rest of the chapters, rest of the questions of all the chapters. Perfect. The outnotes, let me tell you, very confidently are getting ready for you to refer to on the exam day in a very comprehensive manner. Beyond these outnotes, you won't have to refer to even a single thing. They are so comprehensive. Perfect. So thank you so much, everyone. Bye bye. See you all in the next lecture. Take care. See you all, people. Bye. Take care.